Good morning, everyone, and thank you very much for joining us this morning for this third quarter China update. I'm Davy Karstens, and I'm part of Prescient's retail business development team. Joining me today from Shanghai, we've got Tian Pan and Liang, it's up our China business. Tian will very quickly take us through a political update with the Chinese Communist Party conference taking place soon, and also what's happening with COVID, China being one of the only countries to still enforce lockdowns. And then Liang will take us through a sort of a macro overview and what's been happening within the China funds. As with all the webinars, if there's any technical difficulties, just bear with us. If you have some questions to ask the gentlemen, please post them in the Q&A function. The chat function will be disabled on the Zoom. Tian, I think with that, I'll hand over to you.
Great, thanks, Davy. Morning, everybody, and thank you for joining us this morning. I'm going to quickly take us through a bit of a sort of COVID and policy update. But before I do that, just a quick sort of recap of where our product stands. Our flagship Prescient China Balance Fund currently rated Morningstar 5-star. In terms of Bloomberg ranking over 3 years, we're about top 8% globally, and over 5 years, we're top quartile. This is across more than 4,100 or so funds tracked by Bloomberg in the China Dynamic Allocation category. Our China Equity Fund as well, 5-star rated by Morningstar. And in terms of track record, we're currently about almost 4 years, 3.5 years so far. Actually, almost 4 years, and over 3 years, we rank top 90% globally across more than 1,200 China equity funds tracked by Bloomberg. Jumping into sort of a policy and economic update, I think the theme for China is unfortunately still very focused on COVID, but I want to take you through how the dynamic zero is working. So dynamic COVID zero remains official policy in China. So we are seeing continued mass testing of the population. Shanghai, for example, we all have to get tested once every 72 hours to be able to go into public places, including our office. This approach is somewhat tedious, but it has helped keep the economy sort of going, rather than what we saw a few months ago where the entire city went into lockdown. So certain regions still seeing some lockdowns, but nothing as severe as what we saw back in April and May back in Shanghai. What we are seeing on the ground in terms of detailed implementation is that policies are more leaning towards the dynamic side of dynamic zero. What we mean by that is that there are no large-scale lockdowns. The economy keeps going. We saw several weeks ago the city of Chengdu in central western China, a city of 21 million, similar to Shanghai, had a COVID outbreak similar to Shanghai, where Shanghai back in March lasted more than 2 months in terms of COVID lockdown. Chengdu this time, the entire city only locked down for 2 weeks before everything came back online and the economy and everyone's daily lives carried on. So a significant improvement in terms of actual implementation, even though the high-level name for the policy remains the same. So continued mass testing, we've seen a lot of reports on how much it costs to test, etc. So for tier 1, tier 2 cities, some estimates are that it costs the country around 1.5% of GDP, or around more than $200 billion just for tier 1, tier 2 COVID testing. So it is a cost, but we think if we look on the other side, on the balance of things, the benefit of such frequent testing ensures that based on the policy, any outbreaks are sort of caught very quickly, so that instead of locking down hundreds of thousands of people, they can lock down hundreds of people. And that's one of the benefits of the current dynamic zero policy. We are also seeing some relaxation. So for example, Hong Kong waived inbound international traveler quarantine requirements as of September 26th. So that's a very positive signal that the direction eventually should be that slowly opening out to the rest of the world. But right now for mainland China, we continue to focus on the dynamic zero policy. In terms of politics, the 20th CPC Congress coming up this Sunday. I think the title of the slide is "Let's be realistic." So there have been a lot of optimism or speculation of what would happen afterwards. But the reality is that very little official information is ever known about the inside workings and the internal policies of such Congress meetings. So what we are fairly certain of is President Xi himself will secure an unprecedented third term as president and paramount leader of China. What we are seeing is that policy very much focused on stability. So in terms of maintaining economic stability, political stability, and lastly, I think also very importantly, COVID stability. That's why we're seeing very strong implementation of the policies. So a lot of rumors, such as abandoning COVID-0 and softening of foreign policy that's been floating around on the internet, would be very cautious on it. We are following sort of official policy statements, announcements, and press releases to follow the real situation on the ground. So while being realistic and understanding that things probably won't dramatically change after the 20th CPC Congress. In terms of positive signs that we are seeing is that President Xi himself, during the month of September, made his first foreign sort of physical trip to Kazakhstan and then to Uzbekistan. So first, a trip outside of China, many interpreted to be sort of a sign of China opening up. We think, again, don't be too optimistic, but what is positive is that it's all but confirmed that German Chancellor Olaf Scholz and French President Emmanuel Macron should be visiting Beijing in November after the 20th CPC Congress ends. This is a very positive step for China's foreign relation workings and a very positive step for China-EU relations, which has pretty much been on ice since the Russia-Ukraine war began back in February. We do expect further foreign trips to sort of more carry out in-person foreign policy by the president himself after the Congress, and that's another positive sign that we are seeing. In terms of economic data, the picture is not perfect, but it's somewhat mixed. Some sort of negative data, some positive pictures. So in terms of manufacturing PMI, we are seeing the number dropping below the 50 mark again, so showing signs of contraction. But compared to April and May, it's still an improvement compared to the very low readings back in April and May, showing there are improvements in China's dynamic zero policy. All of these numbers cannot only be attributed to China's dynamic zero policy. So over the past 6 months, we've seen the Fed hiking cycle being implemented and global demand for Chinese goods also being impacted significantly. So all these readings are a combination of many factors. So manufacturing PMI shrinking in terms of China exports, the number ties up. We're seeing export growth slowing down to 7.1%, the latest reading as at the end of August. Exports to the US actually declining year on year, but exports are still growing. I think the difference now is that exports alone is now less able to carry China's entire economic growth. So there is demand for policymakers to revive domestic demand and get the economy sort of growing again. In terms of some positive numbers, we are seeing unemployment numbers improve. So since the highs of May, so overall unemployment, the chart on the left-hand side, improving. Youth unemployment 2 months ago hit an all-time high of 19.9%, now dropping by more than a percentage point in the latest reading, end of August. Overall services activity remains positive. So the services PMI, overall services PMI by 50, the blue line on the right-hand side, the Caixin PMI, which is more weighted to small, medium enterprises, actually stronger than the overall official PMI. So showing that small, medium enterprises are being more active and growing more. So that's quite a positive sign in terms of positive economic data. Okay, I think that's it from me. I'll hand over to Liang to take us through more detail.
Thank you, Tian. So I think if you look at the global markets this year, there's not a lot of good news. So starting off in terms of currencies, the CNY has depreciated over the year. Over the past year, the CNY depreciated around 9% to the US dollar. However, I'd just like to point out that pretty much every single currency in the world weakened against the US dollar on the back of the Fed hiking cycle. Ignoring the Russian ruble, which is something completely untradeable, and the Mexican peso for specific reasons, the strongest currency in the world, the Singapore dollar, Swiss franc, Canadian dollar, which each depreciated by around 5 to 8%. We followed that up by the Chinese yuan around 9%, and pretty much every single other currency has done far worse. Australian dollar by 11, 12%, the euro, of course, 15%, South African rand by 17%, etc., etc. So although the CNY has weakened, I think the overall picture of global currencies actually has done extremely well, and certainly more towards a safer asset side than anything else. We all know that the dollar strength is also breaking all-time records. Ironically, the dollar has high nominal rates, but extremely low real rates, a very, very large deficit, and none of those on a fundamental level are actually strong for the currency. So what we're likely seeing is more flight to safety and liquidity issue, rather than really strong fundamentals in America compared to everyone else. If you look at global equity markets in US dollars, it's the same picture. Of course, given that the US dollar is there, equity markets, that non-US equity markets, are also affected by the currency. So some of the tier 1 developed markets, such as S&P, FTSE, and Nikkei, even everyone over year to date, are still down by 25%. China's down about 30%, which is a little bit painful, but still, once again, more or less in the middle of all the different equity indices, the Euro Stoxx, DAX, all down around 33 to 35%. So in other words, not much good news all around the world. If you look at inflation numbers, I think it happened exactly what we expected. The US inflation is high and sticky. Chinese inflation has been low, continues to be low. Even the latest numbers from last night and this morning, last night US CPI numbers, core CPI at a 40-year high, nominal CPI is slightly higher than expected, whilst Chinese CPI numbers are actually better than expected and coming down. Interest rates, the same story. I think previously we always thought exactly the same thing, which is the US interest rates will continue to go up, and China interest rates are low and staying low, and that's exactly what we see. That China interest rate stays low, US interest rates are going up. It is unfortunately, given the flight to safety and China's COVID zero and the property issue, has not resulted in outperformance of the Chinese equity market. But later on, I'll talk a little bit about valuation and sentiment. Right, there's a lot of economic data out there all the time. That's why we build a model. It's impossible to manage money if you're looking at, this is going up, that's going down, this is up, that is down. But our model gives a much clearer picture of what's happening in China. So you can see that after the COVID of Shanghai in March 2022, where the economy is extremely weak, it's actually been very, very strong until recently. So very, very recently, we're having another COVID wave, which has resulted in bigger lockdowns. So you can see the most slight turn in the economic activities. However, since the March lockdown, the economy actually recovered quite well. So on a fundamental basis, they kind of, at least not looking forward, just looking at what happened from March to August, have shown the Chinese economy to be quite resilient and bouncing back strongly after COVID. Monetary policy, of course, remains very easy. So interest rates are low, there's a lot of loans available, there's no shortage of liquidity, and best news yet, as we always see, we're always worried about is that will high inflation around the world result in high inflation in China? So luckily, so far the answer is no. And what this means is that China do not have the need to increase their interest rates. So that's what we're looking at, and that is helpful for if the economy is weak already, but it does mean that we don't have to manufacture a recession or really hike into a weakening economy. China can keep the monetary policy reasonably easy relative to the weaker economy. Right, in terms of valuation, there's two types of valuation. Number one, the China equity market itself is actually quite cheap relative to its own history. So you look at PE around 13 and a half, and on a 2% interest rates environment or 2-3% interest rates environment, that is actually very, very attractive. The second part of the market that a lot of people will have seen and may even know or not know is that Chinese shares listed in Hong Kong, which is of course mostly owned by foreign investors, which would be far more affected by this monetary policy in the US, are actually at all-time low valuations. We are talking about some of the biggest companies in China, some of the most blue chip companies in China, and the index as a whole is currently trading at a PE of around 5.5. This is truly an incredible number, one that we didn't think would occur. And we do think it means that going forward, it's very, very attractive. Now, please note, historically, this index is only made up of government organizations, so state-owned enterprises. So it wasn't great companies. But over the last 2 or 3 years, this index actually included a lot of privately owned companies. So that was no longer the differentiation. They included all the big market cap, all the tech companies, et cetera, et cetera. And when you include all of them onto that, the valuation are almost at all-time low. To us, this is extremely attractive, given the very negative sentiment across the world of everyone, of all investors. I think this has been a segment that absolutely been thrown away. A lot of these companies are trading very close to cash value, which is something that's absolutely insane. Also, some really, really good companies, very low debt with cash value. Right. The economic factors, I'm not going into too much detail to say it's pretty mixed, but once you put it together, exactly as you see in our model, we can see that it has recovered in the last 2 months, weakening a bit. And once this wave is over, we expect the recovery to come through further still. Right. As always, as mentioned, once again, we reiterate our asset allocation framework. Valuation alone is not good enough for us. Policy alone is not good enough for us. Sentiment is very, very important. And as such, our asset allocation moved quite aggressively from low to equity to very, very high equity. And in this period, as you can see, at around April and May this year, you see policy improve, you see valuation improve. We upped our equity allocation. And then as we went towards June, even sentiment improved. But as the sentiment rolled over, our equity was steadily cut throughout the year. So we cut equities, and as such, we ended up with equities right now of around 63%. We're seeing some of the best valuation over a decade, and we're going to go to maximum equity as soon as valuation sentiment starts improving. Because currently, we're just in a situation where sentiment is extremely poor. But we are certainly not going to be dramatically cutting equity allocation from where we are now. And that's simply because other than the time when we started the fund, this is pretty much the most attractive valuation we have ever seen. Right. Furthermore, as we always mentioned, we do get exposure, but we don't only get it by buying equities. We also get it by taking option structures. Earlier in the year, we've shown that this is the type of structure we put in place. And later on, you'll see that it worked out very, very well for us. So we wanted to take our nominal equity up to 90%. So instead of saying 60, we want to buy an extra 30 to 40% equity in HSCI. But if we had done it in equities with market crashing 30%, our alpha would have been -12 or -15. Instead, our alpha for the year is actually still slightly positive. We have lost absolutely nothing, and only a little bit of the alpha we've made this year. And that's because we're able to implement our asset allocation views via dynamic asset allocation, as well as using derivatives. So once again, we'll continue to implement this type of structure over the next 9 to 12 months to be able to capture the upside should they occur, but at least be protected for the first 20 or so fall in the market should it even get worse. And as we all know, with sentiment the way it is, it can always get worse before it gets better. With that said, I want to point out just some of the things that we started looking at. So for example, as you all know, the property market has collapsed, property developer market, should I say, not the property market has collapsed. We're coming to South Africa next week where we'll have more time and doing an in-person roadshow. Please join us. We'll be going to a deep dive of what's going on, what makes it attractive to us and what's going on. But just to give you one example, right? So Sunac is one of the bonds that we've bought actually. Now this bond is a high yield bond, historically traded at around 100 to par value. So for the last 5 years, people were buying this bond at 100, 105 for a yield of 6 to 7%. We bought this bond when it's fallen down to 24. So from 110, it has fallen down to 24. And one of the reasons we do that is that on top of all the deep analysis that we've done on our models, the deep analysis, we look at the balance sheet, the fundamentals, the recovery value, et cetera, et cetera, et cetera. If you do a plain scenario analysis, very, very simply, by buying at 24, if we give it in the worst case scenario that we have a bankruptcy and we only get our recovery 10 years from now, and we only get 20. So just think about that for a second, that for every cent this developer has spent, for every property they've invested in, they're only going to get, every dollar, they're going to get 20 cents back, right? Equity complete wipeout. Equity down to zero, complete wipeout. And if we give that a 60% probability, then we look at the various probabilities of recovery plans, depending on our experience in China of what happened to other bonds. And you can see that from buying at 24, it gives you all sorts of IRR ranging from positive 40% to 285%. Currently, this bond's recovery plan is on our the SUNAP new plan column, giving us around an IRR of 285 if they continue to pay. And what's happening is that every couple of months, every 3 months, they're giving you 10% of their nominal back, then 5%, then 10%, then 15, 15, 30. We've already received the first 10% and the first 5% and the interest rate, right? And should we get some more or less, we've already covered our costs. And should that happen continuously, we'll make over 285% on this bond. In investments, we always say there's no such thing as a bad asset, there's just such thing as a bad price. For a lot of investors that bought at 100, that's a terrible price. We believe at 24, it's a very good opportunity. We, of course, don't only do that, we also consider the risk, right? So we are only buying up to maximum around 30 to 50 basis points. That's less than 1% of our fund in this type of bonds. For combined total, currently only about 1.3%. But even then, by risking a little, we stand to gain a lot of alpha on the entire fund value should any positive outcome come through. So this is an example of the opportunities that we're starting to see in the market. And these are on property bonds and distressed opportunities. Take it a step further, right? We look at investment grade, for example. So all the big tech companies in China went overseas and raised a lot of dollars, a lot of money in their IPOs. We always thought they're fantastic companies, but they're very, very expensive. So what I'm showing here is your Xiaomi bond. So Xiaomi is one of the biggest electronic sellers in mainland China. It's a consumer company. It shouldn't be affected by sanctions. So if you have any logic and reason whatsoever, it has nothing to do with government. Purely private company selling to consumers. And this is the convertible bond they launched in December 2020. At a launch, on the right-hand side is price. On the left-hand side is credit spread. And they launched this bond at a price of 110. It's a convertible bond at 110. And at that point, it was a minus 200 basis point spread. Why? Because it was a convertible bond and you had an option embedded in it, and people were bullish on the stock. So they said, oh, I can buy the bond, make some bond return, and get equity, a cheap option on the equities. Now, given everything that's happened, the equity is down around 50, 60%. Xiaomi as a company, once you take out all their debt, has net cash on hand of $30 billion. So right now today, they can buy back all their debt and have net cash of $30 billion on their balance sheet. The bond has fallen from 110 down to 70. It's a yield of over 8% over the next 3 years. So the thing matures in just 3 years. So we're not betting on 10 years in the future. We're betting on a short 3 years, and credit spread has gone to 400. Now, these are the type of opportunities we're starting to see in the Chinese market. For over a decade investing in China, bonds have been overvalued. This is the first time in history where we're starting to see some really attractive bonds, allowing us to lock in long-term real returns with very, very safe companies that honestly, you will have to see a massive disaster for you to be losing money on this type of purchases. Of course, sentiment is bad, there's liquidity issues everywhere, from the UK doing silly things and pension funds liquidating bonds, etc., etc., etc. Yet in all of those panic, by being experienced, by having a long time in China, we're seeing some of the best opportunities we've ever seen running this slide. Right, and overall, as I mentioned, our balance fund for a 1 year basis looks like we're down 20%, but please remember, almost 10% of that is just the currency. It's just the CNY currency, which has been a little bit weaker over 1 year time horizon. And year to date, we're still beating our 65-35 benchmark, in spite of being actually overweight equities overall. But by taking these overweight positions in a strategic manner and a risk calculated manner, we'll be able to limit any losses while still maintaining the upside if and when it does occur. I think converting to CNY gives us a better picture of what's happening in our funds. On the left-hand side is the equity index. It's down about 22% in CNY, and our equity fund is down about 1% better, beating the benchmark. For the balance fund, the same thing. The 65-35 is down around 13 to 14%. We're down around 12.5 over the same period. And of course, the hedge fund does the best in down markets, where we're down less than 4% in CNY. Since we started for this year. So I'm going to take it and stop there and we'll open up for questions. But in summary, I think in terms of valuations, the H-share market is lower than 2011. You have never seen valuations like this in China. Valuation of H-shares is not as attractive, but remains quite good. I think having a disciplined and creative approach on taking on risk means sure that number one, we're very disciplined. So we listen to our model, we look at our history, we look at our research. So we don't take wild risks. A lot of our competitors have gotten themselves to huge trouble in the past year. Valuation alone is not sufficient. We have a multi-factor model that really helps us control the risk while still maintaining upside. Derivative structures are something that we're strong, and that does exactly the same thing. We're continuously focused on alpha delivery over the cycle. And as mentioned earlier, fixed income is becoming attractive for the first time in over a decade. Opportunity in both distressed and in investment grade markets. And for the first time in Chinese history, credit spreads exist and they're starting to be attractive. So we're actually quite excited about that in terms of the assets we can put into the fund. Finally, valuations are attractive, yields are attractive. The real return looking forward is starting to look much better than we were a year or two ago when people are perhaps far more bullish on the equity market than we are today. So finally, as mentioned, please join us in our in-person roadshow next week where we can get into a lot more detail. It's always easier to see people face to face and really dive into what's happening in the economy, what's happening in the economic sector, et cetera, et cetera. So I'm going to end it there and open it up for questions. Thank you.
Thanks, Liang and Tian. Yeah, I guess you are quite excited to see people again visiting SA for the first time in 2 years. There's quite a couple of questions that's come through, a lot of sort of news flow that we've seen in SA and topical stuff. So I guess let's start with what your take is on China and Taiwan, the North Korean missile that went over to Japan. Does that worry you guys at all?
No, not at all. So firstly, North Korea is North Korea. No one knows what North Korea is doing. So I think don't be too bothered about that. North Korea, I understand if it does anything unilaterally, it's just going to get obliterated. So it's definitely, North Korea, don't worry about that. China, Taiwan, I think we haven't changed from last time. I think what happened in Russia really solidified for China. There is no non-peaceful solution. I think for both sides, people realize non-peaceful solutions are silly. There's no way to resolve any conflict. So I actually expect what's happening in Russia is a lesson to both China and Taiwan and the US that this problem can only be solved in a peaceful manner. And China's core position had always been that we were going to solve this in a peaceful manner. So if I think from our side, we really don't think there's much difference in China policy. I think they've written an extensive white paper talking about their views of the long term, of how there's no change of the situation unless massively provoked to be. And similarly, I think Taiwan and the US is on the same page, understanding that a unilateral declaration of independence will result in war, but no one's actually interested in doing that at all. So I think from that side, we're actually not too worried about that.
Cool, thanks. China banking system. We've heard news that China has problems with its banking system that could cause a collapse. Is there any truth in these stories?
Very, very, very little. So I think really I encourage you guys to come to our meetings next week where we dive into more detail. But the banking system is somewhat insulated from what's happening in the property development market. So I think this problem has seen years coming. And the banks have cleverly sidestepped all of this, right? So the banks have always been the most conservative player in the sector, and they've sidestepped, they weren't part of the big gains, but they sidestepped the downside. So what the banks will lose out on is more the revenue of selling these products, these investment products that they were selling to their private fund clients, but they're not really sitting on a big chunk of that bad debt. We've interviewed insiders in the Chinese sector. We're talking about CFOs of some of the largest Chinese developers in the country, listed developing the country, and they all tell us the same thing, that the banks were actually quite smart and never got involved in this. Anything the bank has is collateralized by the building or the land. So banks are reasonably safe. It doesn't mean there's not people taking pain. There's a lot of people taking pain, a lot of investment funds, a lot of trusts, a lot of non-shadow banking sector that's taking a lot of pain. Unfortunately, that problem is a 30-minute topic in itself, so I can't quite cover that in detail, but next week we'll talk a lot more in detail when we're in person.
Okay. CPI, the CPI being low this year, is that due to the lockdowns or anything else influencing it?
A little bit of both. So I think one of the crucial things that when COVID happened, so lockdown obviously helped because in that sense our economy is weaker than it would have been. So the economy was expected to grow 5.5% at the start of this year. I think at the end of the year, if we reach 2.5 to 3%, that would be a great number. In fact, the real number is probably getting close to 2.5 or lower than 2.5 as we see. So that does contribute less to inflationary pressure. On the other side of the thing is that China has always maintained a very, very conservative COVID plan, right? So without having the big COVID lockdowns in the beginning and by keeping COVID zero, the success for the past few years, China never printed huge amounts of money. Our interest rates were 3% 2 years ago. They were never at 0%. So there was no monetary fuel in the Chinese system as compared to, let's say, the Western system, where a lot of that pressure has been piling up. And finally, of course, also China produces a lot of things internally. And that certainly helped. So we're less swung by all of that. And on top of that, I think the war with Russia meant that China could import much cheaper gas and oil relative to the rest of the world. That's what most of the Western world, India, et cetera, benefits from the same. And that also helps not having a CPI pressure. So it's never just one thing, it's a combination of quite a lot of things coming together. And I think because the central banks don't have the credibility, it didn't get into that bad spiral of people expecting high inflation, demanding higher wages, resulting in this, the wage inflation spiral that perhaps we see in the US. So it's always a combination of a bunch of things. It's one thing that we'll always watch out for, of course, because all of this can change. But as we've seen in the data, so far, so good.
Okay. Sort of on the growth story and economic stimulus, where do you expect China to focus on stimulating growth, noting sort of the less reliance on exports?
So once again, I'm going to reiterate, over the past decade, actually, if you look at Chinese policy making, it's been getting more and more mature. So they are not trying to create another bubble. So I think they're doing what, let's say, historical Western central banks have been done, is that they're not trying to stimulate growth. What they're trying to do is to stop a crash. So every time the growth gets too slow, they will put more money into the system, more credit into the system. But it's up to the market itself to figure out where that growth goes. So they've been trying a lot of things. So recently with COVID, what we've all gotten is kind of small vouchers for just basic consumption. So this is like very small, like 50 RMB for random citizens. So as long as you have an ID number, you can sign up and you get a bit of consumption voucher. So it's very small, kind of slow stimulus because they're not trying to, government don't have money. Anything they stimulate is either more debt or taking the future growth of the country. So what they're trying to do and what we've seen consistently is not to create a big bubble. So we do not expect huge spending in terms of letting housing bubble grow again. We do not expect huge things on pushing one sector, for example. What we do expect, however, is that should growth continue to weaken, that in general, credit will be easier to get, interest rates will be lower, and the market must figure out a way of how to spend that money in the most efficient manner.
Okay. Then on sort of restrictions and ownership within China, does that not skew the investment thesis for foreign versus local investors? And do you foresee any improvement in the sentiment towards foreign ownership?
So funny enough, as financial institutions, we've only got one direction. That's more and more opening up and more protection for foreign investors. So we actually have never seen less access, even throughout this whole trade war. That for investors such as ourselves, for example, we created our new Chinese asset management company to open up for foreign ownership. Car manufacturers are allowed to fully own their car manufacturing capacity in mainland China. Investment banks can start investment banks in China. As a result, a lot of investment banks purchasing more, purchasing the joint ventures out from local companies to become fully foreign owned. So from that sense, I think, especially as a foreign investor investing in China, the protections has continuously been much better in that direction. Similarly, for the currency, it's going to be more and more free, and especially if you're a foreign investor, let's say if you buy offshore CNY, you're pretty much completely free. You can come as you like, go as you like. Your ownership is protected, there's absolutely no problem. So I think from that side, there's not much on that that's happening. So that direction has been very clear. The financial regulators will say there's only one way. We've been opening up for 20 years. We will never take a step back, and we need to open up more. So even right this year, options are allowed to be used by foreign investors for the first time in the entire history. of the Chinese market. Commodity futures and commodities have been opened up for the first time in all of history for China. So from a financial market perspective, it's actually opening up towards foreign investors, and up to even the last 2 or 3 months, we have the latest data in the last 2 months, but up to, let's say, even August, or this all-time record of inflows of foreign capital buying Chinese shares.
Thank you. You mentioned currency there. So how's China's foreign reserve changed over the last year, and are they defending the currency?
So China's gotten a lot more smart than before. So as you recall, a couple of years back, they burned $1 trillion in reserve, achieved absolutely nothing. So now, as you've seen, the currency actually, they don't really try to burn reserves to defend the currency. I'm sure they do it very small on the extreme. So if one day is moving past the band, they're doing it. But the reserve actually hasn't changed much. It's been reasonably flat, ever so slightly decreased. What they've done is just moving the fixing. So the fixing is 75% market driven, 25% signal from the Chinese central bank of where they think the currency is moving too strong or too weak. So what I really like is that this 9% depreciation, for example, it's both from an organic perspective, it's probably the right direction. So we're not trying to be overly strong and overly controlling the currency. Vice versa, they understand there's no point defending the currency when the entire world is weakening against the dollar. I mean, that's just not going to happen. And similarly, I think economic cycles come and go, but the fundamentals don't change. China is one of the most productive nations in the world, exports the most, one of the biggest traders in the world, and that's not going to change in the near future. So I think by maintaining credibility in Chinese monetary policy and fiscal policy is what's going to create demand for the RMB. So I think what's kind of impressive, as I mentioned, that 9% looks bad. If you just look at China, you kind of think, wow, it looks bad. But compared to every country in the world, the only people that are doing better is Switzerland and Singapore, right? And that's good company to keep. So I think on a currency perspective, it's the same thing. It's a combination of the market, a little bit of government intervention, and even that little bit is no longer the old tool making. It's kind of more reiterative, better tool policy making than we've seen before.
Thanks. I think I'm going to ask one more question. There's a couple we didn't get to, but we'll try and send the guys the answers. So what are you expecting from US-China trade war, and more specifically, what is expected to happen to the Chinese tech development with the US banning companies to sell advanced chips to Chinese companies, and how is our fund positioned for this?
I think often, if this type of policies worked, if this type of protectionist policy works, then a lot of people will be doing it. And I think what we've really seen is we understand this type of policy do not work for anyone. So if you look at NVIDIA, Intel, AMD, everyone, they're down just as much as the Chinese tech company. They're down 60–70%. So this tech war and what's happening now is going to force China to create a competitor that is unnecessary for everyone. So back in the days, it was great. We have these huge chip companies in America, Chinese companies bought these chips, everyone's economies of scale, there's a lot more profit for everyone. People focus on what they're good on. By doing this type of protectionist strategies, what it means is that China is going to have to waste a lot of money developing domestic competitors. And on the flip side of that, China is also the biggest consumer market in the world. So all of these companies that are previously selling the chips to China are going to lose that revenue stream. So it's bad for everyone. So for us, I think on the one hand, it does matter, but it doesn't matter as much as people think. And what I mean by that is if you look at Alibaba, for example, and I mean, I don't have time to get too deep into Alibaba valuations, right? Has 1 billion consumers who shop on the platform. How will you stopping this advanced chip make 1 iota of difference? The answer is 0. It makes absolutely no difference on what's going to happen. If you look at Tencent, what's going to happen? Answer is 0. Right? None of that's going to happen. It may slow down China's development towards, let's say, automatic driving cars. For example, that may slow China by a couple of years, where they could be very close to a breakthrough in only a year or two, especially with Chinese policy making and Chinese allowing of, let's say, automated driving. That could delay that development by a couple of years. But over the very, very long term, it hurts both sides. And of course, we hope that sanity prevails, and this type of policy is temporary and get reversed. But if not, if it affects everyone on a relative basis, it is what it is. And you just have to You have to live with it and invest with that in mind. So why do you want a quants company such as ourselves? It's because we stress test scenarios. We look at the most extreme scenarios. We look at the risk. Risk is part of our investment core, right? So why does that happen to, let's say, an active manager? Well, they'll be betting one way or the other. Either you're betting everything will be reversed, or you're betting that's going to be terrible, right? And you either look like a genius or it'll be an absolute disaster. Whereas for us, we risk diversify. It's one of the risk factors in our model, and we make sure that that alone will never contribute excessively towards our alpha.
Okay. Thank you very much, guys, and thank you everyone for attending today. I hope it was insightful. As Liang mentioned, they will be visiting South Africa over the next couple of weeks. If you haven't been invited and still want to attend any of the in-person events, get in touch with us. We have applied for CPD points and we'll send out the certificates as soon as we get sign-off from the FBI. Yeah, and then just thanks again. Have a great weekend. Bye.
Thanks, everyone. Look forward to seeing you all.